The greatest threat to your wealth isn't the market, it's you. It's not inflation, not recession, it's not interest rates, not even so-called experts predicting the next crash. It's the decisions you make when fear takes over or when greed blinds you. You see, the market doesn't destroy fortunes, behavior does. People buy when everything feels safe and sell when everything looks hopeless. They chase what's already gone up and abandon what's temporarily gone down. They mistake movement for progress and noise for wisdom. But here's the quiet truth almost nobody accepts. Wealth in the market isn't built by those who react fast. It's built by those who can sit still. The impatient chase returns. The patient let returns chase them. Every crash, every rally, every headline is just another test, and the question is always the same. Can you keep your emotions from deciding your financial future? Because if you can, then time, compounding, and discipline will do the work that no prediction or hot stock tip ever could. When people talk about investing, they often talk about brilliance, the genius who picked the right stock at the right time, the insider who foresaw a crash before anyone else, the manager who beat the market. We celebrate glamour, we chase stories of extraordinary skill and timing. But here's the truth most investors don't want to hear. It's not brilliance that determines your success, it's arithmetic. And the arithmetic is brutally simple. The more you pay, the less you keep. Every percentage point in fees, every hidden cost, every trading expense silently eats away at your return. You don't see it day by day, but over decades, it compounds like rust corroding your wealth in ways that no fancy strategy can offset. Consider two investors, each earning the same market return, say 8% per year. One pays 0.5% in fees, the other pays 2%. That tiny difference doesn't look like much in the short term, but stretch it over 30 or 40 years and it becomes massive. The first investor ends up with nearly twice as much money. Nothing magical happened. No secret formula, just simple arithmetic. Costs compound negatively just as returns compound positively. Yet, for reasons that are more emotional and rational, most people ignore this. They'd rather pay high fees to feel like they're part of something sophisticated than quietly build wealth through discipline and patience. The financial industry has a powerful incentive to keep investors distracted with glamour, because glamour sells, complexity sells, promises of outperformance sell, low cost, boring, market matching discipline, that doesn't. The industry thrives by convincing you that success comes from access to special insight, secret research, or advanced models. But what it really thrives on are the fees you pay to chase those promises. The less you think about cost, the more they earn. And that's why one of the hardest disciplines in investing is resisting the temptation to pay for excitement. When you invest in a fund or a manager, remember this: for every dollar that goes to fees, that's a dollar that will never compound for you again. It's gone forever. You're not just giving up that dollar, you're giving up the decades of growth it could have generated. That's the silent killer in most portfolios. Investors focus on returns, but it's the cost side that often determines who wins and who falls short. A 1% annual cost might sound trivial, but on $1 million portfolio over 30 years, it's hundreds of thousands of dollars lost. And true investing success is not built on finding the next big winner, but on capturing what the market already offers and keeping as much of it as possible. Markets give, costs take away. Your job as an investor is to minimize the taking. The smartest investors understand this. You don't have to outthink the market. You just have to avoid being outcharged by it. Keep your costs low, your process simple, and your patience long. The glamour may belong to others, but the wealth, quiet, compounding, and real, will belong to you. Most investors spend their lives chasing the illusion of outperformance. The idea that somewhere out there is a stock, a fund, or a manager who can beat the market consistently. It's an appealing dream because it plays to our desire to feel smarter, faster, more capable than the crowd. But what most people never stop to realize is that the market isn't some external opponent you can outwit. It is the sum of all investors, all trades, all human ambition in enterprise form. To beat it, someone else must lose, and after costs, the odds are heavily stacked against you. So rather than trying to outsmart the market, the wisest choice is to own it, to participate in it, to let the collective effort of millions of people working every day to grow their businesses, create value, and drive progress work in your favor. When you own the market, you own every great company and every struggling one. You own the innovators, the disruptors, the survivors, and even the failures. And yet, through the passage of time, the total output of all that human effort tends to rise. Economies expand, productivity improves, population grows, technology advances. Across the chaos of daily volatility, that long-term trend of growth persists. Owning the whole market means you don't have to guess which company will lead the next revolution, whether it's in energy, medicine, or artificial intelligence. You simply benefit from the collective progress of all of them. This approach removes the most dangerous element in investing, the need to predict, because prediction is the enemy of consistency. No one knows which sector will shine next, which company will stumble, or which global event will shake prices tomorrow. But when you own everything, you don't have to know. You accept the ups and downs as the natural rhythm of capitalism itself. You're not betting on who wins. You're betting that human progress over time will continue to create value. And history has shown, despite recessions, wars, crises, and bubbles, that progress endures. Trying to beat the market is like trying to outswim the tide, exhausting, unpredictable, and rarely successful. But owning the market is like floating with the current. You still experience turbulence, but the long-term direction carries you forward. That doesn't require constant decisions, endless monitoring, or emotional reactions to headlines. It only requires trust in the system of enterprise and the discipline to stay invested. Over time, this quiet patience outperforms the frantic attempts of traders and speculators who jump in and out based on fear or greed. Owning the market is not about surrender, it's about wisdom. It's about recognizing that capitalism's power is not in one company's story, but in the combined force of them all. When you own that collective story, you own the long arc of human endeavor, the factories built, the innovations born, the profits earned. You don't need to pick the next big winner. You already own it along with every other possibility the future holds. That's not defeat, that's freedom. Freedom from chasing, from guessing, from losing to costs and emotion. You don't need to beat the market, you just need to let it work for you. The greatest advantage any investor can have isn't intelligence, luck, or access to secret information. It's time. Time is the quiet, unseen force that turns small decisions into great outcomes. It's the multiplier that transforms modest investments into significant wealth. Yet time is also the thing most investors fail to trust. They grow restless, anxious, eager to act. They want results now, not later. But markets don't reward impatience. They reward endurance. And those who learn to let time work for them almost always end up ahead of those who try to outsmart it. When you look at the stock market day by day, it can feel like chaos. Prices go up and down, news breaks, fear spreads, optimism returns. It's easy to get swept up in the drama, to believe that today's movement defines the future. But step back and stretch that view across years, decades even, and a different picture appears, a steady upward climb marked by short-term storms. Those storms are temporary, progress is permanent. Every crash in history has eventually been followed by recovery, and every period of panic has given way to growth. The patient investor doesn't see volatility as danger, they see it as noise that fades over time. The real power lies in compounding. Compounding is what happens when your returns start earning their own returns. It's slow at first, almost invisible, but given enough years, it becomes extraordinary. The secret, of course, is that compounding only works if you stay invested. Pull your money out during market declines, and you break the chain. Miss just a few of the best performing days, the ones that often follow the worst ones, and your long-term results can fall dramatically. That's why trying to time the market rarely works. You might be right once, maybe twice, but no one can predict consistently when to get out and when to get back in. The cost of being wrong even a few times is devastating. Many investors make the mistake of believing they can wait for the perfect time to invest or sell before things get bad. But the perfect time doesn't exist. The market doesn't ring a bell when it's about to rise or fall. The perfect time is simply now, followed by the discipline to stay the course regardless of what happens next. Over decades, the upward march of enterprise and innovation does the heavy lifting. Your only job is to give it the time it needs. Patience in investing isn't passive, it's active discipline. It's choosing not to react when everyone else panics. It's trusting in history, in arithmetic, in the compounding of capital over time. The impatient investor looks for shortcuts and ends up sabotaging themselves. The patient investor does less, and gains more. In the end, the market doesn't reward those who move the fastest. It rewards those who wait the longest. Time is the friend of the investor who stays calm and the relentless enemy of the one who can't sit still. The human mind loves complexity. It makes us feel intelligent, involved, and in control. When we hear about intricate strategies, clever algorithms, or exotic portfolios, we assume they must be better. After all, if something is simple, how could it possibly outperform the vast machinery of modern finance? Yet the truth is often the opposite. Complexity doesn't guarantee success. It usually hides risk. Simplicity, though unglamorous, has a habit of winning in the long run. And nothing embodies that truth more than diversification, the quiet, mathematical protection against the unknown. When you try to pick individual stocks, you're stepping into a game where the odds are heavily against you. Every time you buy, you're betting that you know something the rest of the market doesn't. You're betting against professionals with deeper data, faster systems, and billions in capital. Even if you get it right a few times, luck can disguise itself as skill, and sooner or later, that luck runs out. History is full of funds that shined brilliantly for a few years only to fade into mediocrity or collapse when conditions change. The market rewards consistency, and consistency rarely comes from guessing games. Diversification is the opposite of guessing. It's the acceptance that we don't know which company, sector, or country will lead the next wave of prosperity, and that's okay. By owning a broad mix of investments, you remove the need to be right about any single one. You participate in the collective outcome of enterprise rather than gambling on its individual players. Some companies will fail, others will thrive, but together they form the engine of economic growth. That engine over time tends to move forward. Simplicity in investing isn't about doing less thinking, it's about focusing on what matters most. It means designing a plan you can understand, follow, and stick with through every market cycle. When your portfolio is simple, broadly diversified, and low cost, you free yourself from endless decisions. You're not trying to chase trends or predict tomorrow's winners. You're simply capturing the steady march of global business. And because you're not trading frequently or switching strategies, your costs stay low, your taxes minimal, and your peace of mind intact. There's a beautiful irony here. The more you simplify, the better your results often become. The investor who builds a globally diversified, low-cost portfolio and leaves it alone will likely outperform the majority who constantly chase performance. That's not because of superior intelligence. It's because simplicity removes the two greatest enemies of investing: emotion and error. Complexity invites tinkering. Simplicity invites patience. In the end, diversification and simplicity are acts of humility. They acknowledge that no one can consistently predict the future, and therefore the best defense is broad participation. They allow you to stay invested through storms and sunshine alike, confident that the collective progress of human effort will carry your wealth forward. Complexity might look clever in the short term, but simplicity endures quietly, efficiently, and faithfully, decade after decade. When it comes to investing, most people spend their energy searching for the perfect fund, the perfect asset allocation, or the perfect moment to buy. They look outward at the market, the economy, the news, hoping to find certainty in a world that never offers. But the truth is, success in investing is determined far less by what you own and far more by how you behave. The market will always fluctuate, but your response to those fluctuations will decide your fate. Behavior, more than brilliance, is the true differentiator between those who build wealth and those who destroy it. You can have the best fund in the world, the most carefully constructed portfolio, and the smartest plan, yet still fail if you can't control your emotions. Because the temptation to act at the wrong time is constant. When markets soar, greed whispers that you're missing out. When they fall, fear screams that it's time to run, and both emotions push you to make decisions that harm your long-term results. Buying high and selling low is not a strategy, but it's exactly what happens when emotion overrides discipline. The hardest part of investing isn't building the plan, it's sticking to it when every instinct tells you not to. The financial media amplifies this problem. Every day brings a flood of predictions, hot takes, and dramatic headlines designed to stir emotion, not to build wealth. The noise can make even the most rational investors second-guess their approach, but none of it changes the underlying truth. No one knows what the market will do next week or next month. What matters is how you position yourself to benefit from what the market will do over the next 10, 20, or 30 years. That requires patience, discipline, and the humility to admit that the future is uncertain and to stay invested anyway. Good behavior also means focusing on what you can control: costs, diversification, savings rate, and time in the market. These are the levers that actually shape your outcome. You can't control market returns, but you can control how much you let fees and taxes eat into them. You can't predict recessions, but you can prepare by holding a balanced portfolio. You can't eliminate risk, but you can make sure you don't take more than you can handle emotionally. These small, steady decisions form the foundation of long-term success. Bad behavior, on the other hand, doesn't just reduce your returns, it destroys them. Every panic sell, every performance-chasing switch, every attempt to outguess the market comes with costs that compound against you. Over a lifetime, they add up to massive underperformance compared to someone who simply stayed the course. The great irony is that in a world obsessed with intelligence and strategy, the most important skill in investing is self-control. It's not about knowing what will happen next, it's about having the discipline to do nothing when doing nothing is the hardest thing to do. In the end, your behavior is your greatest asset or your greatest liability. The market rewards patience, not prediction, and the investors who master their emotions master their future. But friends, here's the paradox. The strategy is obvious, the strategy is open, strategy works, and yet nearly everyone ignores it because they believe in beating the market rather than owning it. They believe in shortcuts rather than the long, steady climb. Let me close with this. Let the market work for you, rather than you trying to work the market. Pay as little as possible, own as much as you can, stay the course for as long as you live, and in that simple discipline, you give yourself the best chance of winning the only game that really counts. Thank you. Stay invested, stay humble, stay the course.